So again, welcome back to the third session. That is after exhaustively discussing the physics and chemistry Nobels, we boil down to a little less interesting for my point of view, but it is important because currently we are in the what we can say that we are going or foreseeing a kind of major recession after what the inflationary processes, the FedEx rates, and the fuel price rise, the conflicts, the Russian invasion of Ukraine. So all these factors are coming together, and they have caused a massive economic crisis. And if you remember that even now, earlier the Eiffel Tower used to light up. The city of Paris at night. Even now they have stopped lighting it that frequently also. So Ben S. Bernanke, Douglas W. Diamond, and Philip H. Davy for understanding the role of banks in the economy, particularly during financial crisis. Normally, it talks about the basics. You might say after reading whatever I'm going to discuss that they did not do anything special, but the fact is the study that this economists do, they are much in detail, which is beyond the normal scope of general discussion. Science is still some piece of stuff that can be explained via knowledge. If we have some basics, for example, I also don't have much knowledge about quantum mechanics or bioorthogonal chemical reactions, but with simple knowledge, if we know the simple things, like in chemistry I know about the saccharides or the carbohydrates, I can easily build upon in consonance or in coherence with the Nobel laureate. Similar for quantum mechanics, if I know some of the basics, how photons work, the discrete quanta, how the photoelectric effect works, so I can build upon, or I can infer a lot of things from that. But in case of economics, it's a lot, we are going to discuss the basics, not the actual research. So basically, when it comes to bank, why are banks important? It's an important financial intermediary. So if someone asks you why are banks important, what do they do? So basically what happens is that banks do not have any money of their own, they just facilitate exchange. But why do we need banks? Why can't we directly exchange the money? So the point is, some people need to save, some people need to invest, or some people need to borrow money to invest in certain projects. So this, if all this is happening at the same time, the system will become very cumbersome. So what banks do is, you might already be knowing this, some persons who are interested in savings, in opening the savings account and depositing their money, their hard-earned money with the bank, so that bank is safeguarding that. But at the same time, all the persons who deposited the money, they will not be interested to withdraw that money. So in the time being, in order to earn interest from the banks, the bank makes that money available in the form of loans to the other funds or the investors to borrow those funds and invest in different assets. And the government also does the same thing, like makes a lot of borrowings from different sources in order to invest in the capital infrastructure. So what happens during a financial crisis? For example, if you have been following news again, in China, what is happening? You might have come across a term or phrase known as bank run. What is happening is, due to the fears of the market collapse or economy collapse, lot of lot of savers or lot of people have just run to the banks, or they have just besieged the banks in order to withdraw their money, because they are under the impression, or they fear that the bank might not be able to return their money after the collapse happened, and some or the other kind of bailout will be there. And if the people want their money back to even purchase something, some emergency comes, so at that point of time the banks will not be able to fulfill their obligations. But what will happen in that case is, in that case, when lot of deposits are being withdrawn by the people, then the money which the bank has to loan out a particular amount to the investors, or if a person has to pay back loan with an interest, that will drastically be affected. So it's a vicious cycle. If the funds will not be available at the bank, they will not be available for the investors or the corporates to borrow, and particularly some investments which are required for the growth of the economy, for the growth of nation and the world in specifically, that will not happen. So it will lead to an economic collapse. So what these three individuals and Nobel laureates, they have done the research, they worked upon the concept of why, not only why we need banks, but why do banks collapse, and if the banks collapse, how we can rectify that situation, and in order to rectify this situation, what measures or efforts can be done to make the banking system more robust and more trustworthy, more sustainable in the long run, and if some financial crisis occurs in the future, how to better manage. So that forecast or that foresee how the banks or the finance, the economic structure of a particular country functions or a particular banking system functions, the light was shed by these three individuals on those concepts. So again, why this Nobel was given, I've already discussed in brief. Modern banking research clarifies why we have banks, how to make them less vulnerable in crisis, and how bank collapses exacerbate financial crisis. Foundations of this were laid by these individuals. Then their analysis have been of great practical importance in regulating financial markets and dealing with financial crisis. Of course, this economy, because a lot of factors, much more juxtaposition or superposition that is involved in chemistry or physics. So a lot of factors which are beyond the scope of this discussion, so we'll not go into the depth. Then later, when the pandemic hit in 2020, significant measures were taken to avoid a global financial crisis. The laureates' insights have played an important role in ensuring these latter crises did not develop into new depressions with devastating consequences for society. So that is the important work that has allowed them to be bestowed upon by the Nobel Committee. So now individually we can concentrate on what each of the Nobel laureates worked, their specializations. So through statistical analysis and historical source research, Bernanke demonstrated how failing banks played an important, decisive role in the global depression of the 1930s. We all know how devastating it was. Then, worst economic crisis in modern history, collapse of banking system explains why the downturn was not only deep but also long lasting. There were people who became homeless, and a lot of other drastic things that happened, and it was a long time before the economies, various sundry economies could recover, and it added the importance of well functioning bank regulation thanks to this research. So this I have given the recent example of the protests that were held in China against the economic system, not against Xi Jinping, although one recent protest was held against him. So this is about the bank run. So banks and money are volatile and vulnerable. That is no, an economic system cannot work in perfection. So when people were unable to withdraw their money from a few rural banks in China, they witnessed bank runs. A bank run may happen where many savers try to withdraw their money at once, which can lead to a bank's collapse. Some bank collapses have also happened in India. Some rural banks have closed, but we'll not discuss that here. So the questions that were asked: if banking collapses can cause so much, could we manage without banks? The answer obviously is no. Must banks be so unstable, and if so, why? For example, the investment bank crisis, the 2008 financial crisis, was due to a majority of purely bad decisions, and which did not take into consideration several. You might have heard about credit default swaps, in which the ratings of the rating agencies like Moody's were manipulated in order to disguise or reveal the actual credit worthiness of a particular fund or a particular corporation. Then, must bank be so unstable, and if so, why? How can society improve the stability? And why do consequences of a banking crisis last so long? And if banks fail, why can't new ones immediately be established so the economy quickly gets back on its feet? One example of the bank restructuring that we have witnessed in India, recently the asset reconstruction company came into picture, the insolvency and bankruptcy code, the bailout procedure, the Indradhanush, and making the banking management more responsible to their stakeholders and shareholders. So these are the questions, but the conflict that arises here is that savers want instant access to their money in case of unexpected outlays. For example, like we discussed in the bank run of China, while businesses and homeowners need to know they will not be forced to repay their loans prematurely. So obviously, if the savers are hellbent or insisting on withdrawing money from the bank, so in order to fulfill their obligations, they have to fulfill their liability. So obviously the money which the savers had deposited, that they have now transferred with, they are with the people who have borrowed loans for the real estate or even purchasing car or small assets. So they would have to apply certain strict conditions for the return of that money, because it's a kind of savers, it's a kind of demand deposit in simple terms. So if the savers want their money, so the bank has to guarantee that whenever they want it. Then the two other individuals, Diamond and Philip H. Ivey, so they work together to develop theoretical models explaining why banks exist, how their role in society makes them vulnerable to rumors about their impending collapse, and how society can. So their research feeds or builds upon the question. They try to answer or find solutions to the questions that we have discussed previously. These insights form the foundation of modern bank regulation. So the model captures the central mechanisms of banking as well as its weakness. Then it is based upon households saving some of their income, and this is just the text. Then that this does not happen in the same time for every household allows for money to be invested. So again, so this uniformity needs to be established to in order for the sustainable functioning of the banks. So these models, these three Nobel laureates or individuals, they have worked on research. They have done research and established models so that these bank runs or these type of bank collapses don't happen. And they argue therefore that banks emerge as natural intermediaries that help ease liquidity rather than force the economy into a kind of recession or depression. Then again, both these two individuals, they worked, it's the same repetition of the previous, but with massive financial crises that have been witnessed in history, it is often discussed how banks need to be more careful about assessing the loans. So normally when we talk about NPAs and the big banks, we talk about Vijay Mallya and all those diamond merchants, famous diamond merchants. And so the poor decisions, the poor management, the proper regulations, and that the strict measures are not in place, and how the financial market should be regulated, and channeling savings to contribute to productive investments is a question that researchers and politicians continue to wrestle with. And the research being rewarded this year and the work that builds upon it makes society much better equipped to take on this challenge. So this was a brief discussion of the economics Nobel, and we'll meet with the next Nobel Prize after a short break.